All right, everyone, let's jump right into this with no introduction so you can get back to some more entertaining YouTube videos, even though my video can save you a hell of a lot of heartache and money, but whatever. Here we go. So what you're looking at here on the left-hand side, the conventional rate spectrum, VA rate spectrum, as you can see how I've labeled them. And I know this differs from what you see when you're browsing the internet or looking at any other advertisements. You'll typically see the lender advertising only one of these rates in each category: one 30-year fixed conventional rate, one 30-year VA rate, one 30-year FHA rate, etc. These are actually all the rates that are available. What happens is the cost associated with these rates go up and down. And of course, as of late, they've been going way up. Think of these rates as stocks. There's a cost associated with each one. I know there's a bazillion people on the internet and people that you know and some friends you have that have been working in the mortgage industry a few years, and they refer to things as rates going up. The rates aren't going up. The costs for the rates are going up. But whatever, I'm just a guy with 24 years of damn banking and lending and brokerage experience. So at this 3.5 rate, it is actually still available, but it costs a lot of money. And down here, this is where you get a credit, but this rate is too high for most people. So the lenders hang out in the middle in what I call the Goldilocks zone. Let me get my marker out instead of this laser pointer here, and let me show you. On the conventional rates, you're going to see them advertised right now. You'll see them advertised between about 5.7. This was as of probably the 14th of what the hell month is this? June. That's right. And now I'm squiggling my line all over the place. So right about here is where you're going to see the lenders advertising. Careful when you see them down here, because usually they're kind of full of shit. They're packing tons of closing costs in there, which is no problem with that as long as they're disclosing that to you, not trying to be sneaky boys and girls. And then on the VA side, the range that's being advertised is right in here. So you're going to have higher cost at the, let me get my laser pointer back out, higher cost at these rates here and lower costs here. Again, all because their cost doesn't mean it's horrible, because these will work for people staying in there long term. This is the rate spread that you're going to see advertised. Now, all because you see something advertised doesn't mean you actually qualify for it. Not to muddy the waters up anymore, but I'm going to break out the mud. Check out this stuff here. All right, these are pricing adjustments over here, and these apply to every loan. We call them loan level pricing adjustments. Just think of them as cost adjustments, because each one of these affect how much these interest rates are going to cost. So on top of whatever the respective lenders are charging, like I showed you on the last slide, you've got these cost adjustments here. Credit history will affect the loan amount, and I'm not just talking about the credit score. You have some derogatory major items like bankruptcies, foreclosures, etc. That's going to impact it, even if you have a high score. The size of the loan, yes, the size of the loan impacts it, and it can impact it drastically. The loan to value, how much you owe on the loan relative to the value of the home. Loan to value. In other words, if you're doing a refinance, how much equity you have. If you're doing a purchase, how much money you're putting down. Whether you're living in it or not, or if it's a second home or an investment property, this occupancy here, whether you're taking cash out, no matter what the reason is, if it's cash out for debt consolidation, home improvement, or you're putting two mortgages together and it counts as cash out, this is going to impact the pricing. Whether it's the property type, single family residence, detached, single family residence, attached, condominium, manufactured home, etc., the loan term, 30, 15, 20, etc., the loan type, conforming, jumbo, ARM, interest only, etc. Whether you have your taxes and insurance included or not, escrowed. And then also on here to finish it off, your favorite food. No, I'm bullshitting you a little bit on that, actually. Sorry about that. I couldn't resist. So no, it's not favorite food. So you got, on top of what the lenders are pricing, you out at, you also have these loan level pricing adjustments that are impacting the interest rate pricing. So how do you shop and look around for the rate that's the best deal? I'll say. Well, Some folks will say, oh, track these mortgage-backed securities, and they sound like real smart, intelligent folks when they're doing that. And some other folks will tell you, oh, check out these 10-year and 30-year and these treasuries, or check out the mortgage-backed securities and the treasuries. Well, I don't mean to burst your bubble. I always have this damn buzzkill information, but that's the burden of actually having experience and being an active licensed mortgage loan originator who does this for a living and has been doing so nonstop in 3 different capacities. You actually get, I don't know, the real information. So no, if you track these mortgage-backed securities and 10-year treasuries, you are not going to become the Warren Buffett of mortgages. It's cool to do it, but it's kind of like this next slide here. It's kind of like being stuck in traffic and then listening to the traffic report that tells you stuck in traffic. It's cool to know, but it doesn't get your ass out of traffic. And the 10-year treasury, just looking at that alone, and the mortgage-backed securities, it's just going to tell you what you already know. The rate pricing has been skyrocketing since January, but you ain't going to do anything about it or be able to predict it. Here is what I would advise right here. Track the rate pricing at the source, which are the lenders that set the pricing, the brokerages, the lenders, and the banks. Now, there's going to be differences in between the how you'll find brokerages, lenders, and banks are pricing out their loans. So you want to track 3 to 6 of your favorite companies. So pick some out. Now, I know 6 might be overkill for some of you, so just pick 1 in each category: 1 brokerage, 1 lender, 1 bank at least. And obviously, you know, the brokerage, well, you could, I don't know, let's say start with a fine company like United Real Estate Capital at urecapital.com. Come on, man, I got to plug my own company. I do a damn good job. I'm proud of it, and I know what I'm doing, and I save people a crap load of money, and have been doing so for years. And then, like, let's say, so you get a brokerage, and then your whatever, maybe your bank that you bank with already, like a Wells Fargo or something like that. And then a lender, like say a Quicken Loans or someone like that, a Loan Deep or whatever, whichever your favorites, and you want to track those, just go on there, look at their rates, their advertised rates weekly or every couple weeks or so you can stay in touch with what's going on. And I can almost promise you, if you do that, it will work. It'll give you a great perspective about what's going on in the mortgage rate market to help you choose and lock your rate in at the right time. Literally can save you thousands of dollars. For example, the difference between, let me back up. I'm sorry. So coming up in this next evolution of the mortgage market, we're going to get some drops. Now, don't expect it to go back to 2.875 with no cost. That ain't happening. But we will get some drops that could amount to you saving literally $4,000 to $7,000. These drops will not last long. So if you're sitting there on the sidelines going doop, 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 and not checking out these mortgage rates, you're going to have no damn clue. Not until some dizzy newscaster gets on and says, mortgage rates are dropping down. But by the time they get on there saying mortgage rates are dropping down, it's too damn late. You missed out on the deal. So if you take my advice and you're tracking these things every couple of weeks or weekly, it only takes you a few minutes. You want to go with the companies that advertise their rates like I do, and like say a Wells Fargo and Quicken does. If the company doesn't advertise their rates, make it easy for you to see their rates, to hell with them. Don't deal with them. They're just trying to be slicky boys because they want you to get there and call them, and then they figure one of their slick salespeople, they're not really professional mortgage loan originators. They're just salespeople. Nothing wrong with salespeople, but they're bad salespeople, and they're just selling interest rates. And that's not what you do in this industry as a professional. You don't sell interest rates, but that's what they do, and they figure they get you on the phone and sell you interest rates, and that's not how it's supposed to work. So go with the companies that are advertising their interest rates. All right. Now, why do I recommend a brokerage, a lender, and a bank? Here's why. I'll just zip through it really quick. You can read this later, but there's no single banker, lender, or brokerage that is all things to all people. Never has been. There never will be. And on top of that, you're going to have some brokerages that price better than others, some banks that price better than others, some lenders that price better than others. And there are some loans at different times, and because it's going to change. There's sometimes when certain loans are better to be done at a brokerage. There's sometimes when certain loans would be better done at a bank. And there's sometimes when there's some loans that would be better done at a lender. And there's sometimes where it doesn't matter a cat's ass. Actually, it'll be good at either one of them. So if you're checking all three, you're gonna cover all of your bases there. So I don't like to give out advice like right now. For example, if there's a certain type of loan, like say for example, a manufactured loan or a jumbo loan or super jumbo loan, I would probably point you in the direction to one of these three, but I want to create a system for you that's easy to follow so you don't have to remember. Also, things change. So check with all three. Check the brokerages, check the lenders, check the banks, and that'll cover all your bases here. Now, all because of a company, all because a company has many type of loan products. They offer many types of loan products. Doesn't mean they're good at doing them. Hell no. It's totally false. We do these loans kind of like the lenders. We're like In-N-Out Burger. There's a few things that each lender, each brokerage, each bank does well. I don't give a damn if they have 100 products on their menu. There's only a few of them that they're going to do well, and I know this because I've worked at all three: the brokerages, the lenders, and the banks, an equal amount of time. I saw some videos before, or one video where some guy is who maybe I think he just worked at a bank or something like that, and he's recommending you want to go here for this type of loan and here for this type of loan here. Bullshit. So no, that's not the case. So track a brokerage, track a bank, track a lender. All right, so let's get you all finished up here. This is something for a different type of video. I'm going to do a loan shopping video, but I want to toss it in there because it is relative to these rates. When you're going along selecting a lender or bank or brokerage to go with, three factors going to make or break your entire experience and what kind of deal you get. Number one, and this is in order of, well, actually, I should probably have saved the rates for last, but whatever, this is good for now. How well do they underwrite your type of loan? That is the biggest thing. There's a bunch of cavity creeps that will advertise, they'll do this and they'll do that, but when it comes to, and they have a good rate on it, a good rate pricing on it, but when it comes time to underwrite it, it's a friggin' nightmare. They're asking you for one stupid, idiot, nitpicky thing after another. Some of you that might run across this video know what the heck I'm talking about, you homeowners. Just all kinds of stupid, obvious things that are not necessary. It's only because they're overwriting your loan, not underwriting your loan. And it's just that they suck at underwriting that particular type of loan, where you get the point. Let's go to the next one. How good the interest rate pricing is for your type of loan. And this goes back to the previous slide there. Does this institution, this company, are they good with whatever type of loan you're doing? They can underwrite them and they have great pricing for them. They may underwrite the hell out of it, but if their rate pricing really sucks, you might want to try to find another place that can underwrite well and also has great pricing. And then this one right here, which probably should have been number 2, how easy are they to work with? Oh my freaking man, oh man. Now this one right here, silly things to complicated things. Can you call them? Can you call them and get somebody on the phone? Can you get the original loan originator that was so happy to take your application? Now they're damn missing in action. Or how about the processor that's supposed to be working on your loan and you don't know what the hell happened to them? You can call missing persons, they still won't find them. And then you're submitting. They're asking you for the same paperwork over and over again, and they're taking like 20 damn years to get a loan done that should have taken only 21 days. And your rate lock expires. They give you a free rate lock, and then the next one they want to try to charge you for it because they took so long. And then they took so long, your paycheck stubs expire, and they say we want more paycheck stubs, and your bank statements expired because they took too long and they want more bank statements. And then issues come from the bank statements that you gave them, and it takes even longer to resolve those issues that showed up on the new bank statements that you gave them. how easy they are to work with. Actually, maybe that should be number one. So remember these factors here. Don't just go, I'll leave you with this one last thing because we're done here, but don't just go with the interest rate. A lot of people, I call them rate zombies. They're running around just asking, what is your rate? What is your rate? What is your rate? They don't think about any of the other things. Their asses up a creek with the paddle till they're in process with the devil, or after the fact, and they need something and they run into a problem and they find out this institution's just going to leave them in the lurch. It's not about the rate. Just looking at the interest rate, that's like, hooking up with somebody, going out on a date, whatever. Your whatever partner you go out with, and you just go out with them, say just because of how much money they make. And then you find out they're a complete dickwad or whatever later on. So don't just go based on interest rate. Don't become a rate zombie. Look at all three of these factors. All right. So I'll leave you with that. Email me, call me with questions. Go ahead, put a link in the description, obviously, to the website. Shoot me an email, give me a phone call, throw some questions at me, or if you're too shy, you can put some questions in the comment and I'll answer it at a group. Take care, good luck, and I'll talk to you on the next one.